external liability, as the name suggests, the amount which is due to be paid to the external persons, to the outsiders. Now the question arises, who are the outsiders? Outsiders are those persons from whom we might have taken the goods on credit, or else we might have taken a loan from the bank. So all the persons or the organization from whom we have taken the goods or we have taken the money are basically our external liabilities. What is the meaning of a liability? Liabilities are those amount, the money which we owe to the other person or the other business entities. So what happens when we go for buying the goods for our business, when we go for buying the assets for our business, and at that time we don't have the money, so we buy the goods on credit. Exactly. Credit means the amount for the goods or the assets will be paid after a period of time. That simply means that we are purchasing the goods, we are having the goods, we are taking the goods to us, but we haven't paid the cash or the money yet. So that is the liability, the amount we owe, the amount which is liable from our side to the other business entities or the person. That is known as a liability. So liabilities are of two types. What are the two types? The first one is the external liability. The second one is the internal liability. So first talk about the internal liability. Internal liabilities are those liabilities which a firm is liable to the internal persons. Now, who is the internal person? Internal persons are those persons who have just started the business. Basically, these are the owners. So when I talk about the sole proprietorship, so the internal liability will be the amount due to be paid to the owner, that is the proprietor, sole proprietor of that business. So he is basically a person who wants to get back the amount which he has invested to start the business. Now, when I talk about the partnership business, so in a partnership business, there are many more partners who have started the business. So all the amount of capital which has been invested by the partners is a liability for the business, because as per the separate legal entity concept, it simply means that the firm, that is the business entity, is totally different from its owners. As per the law says that there are two types of persons. One is the natural person, that is the owner. The second is the artificial person, that is basically the business. Now, so for the business, this is a liability which has to be paid back to the owners at the time of winding up of this business. Is that okay? So now if you are clear about the internal liability, so all the amount which is liable to be paid to the owners is basically known as the internal liability. So it doesn't stop here. There are more things as well. Like, for example, the amount, obviously a business is started just to earn the profit. Now, if the business wants to earn profits, they will do the transactions, like they will purchase the goods, they will sell the goods. So when purchasing the goods and selling the goods, by keeping in mind the margin, so they will earn a profit. So the amount of profit earned by the business is also the liability for the business towards the owners, because the business owner has started the business, he has taken the risk, and he wants the money back from the business, including the profits as well. So the amount of profit which is earned by the business, it is also a liability. That amount is also the liability for the business to be paid back to the owner. So in short, the initial capital investment which has been invested by the business owner is the liability, and the profit earned by the business is also a liability for the business entity. Now, if this internal liability is very much clear to you, now one more thing, exactly, there is one more thing. Now what happens is, when I talk about the companies as a whole, that is, first we talked about the sole proprietorship, second we talked about the partnership business. Now the third organization is basically a joint stock company, where there are many owners, there are many shareholders who have invested the amount in the business. So the shareholders fund is basically a liability in the form of capital which a business owes to the shareholders. Okay, because the shareholders are the main owners of the company. Now, and when I talk about the profits, the profits is the amount which a business earns from the transactions which they do on a regular basis. Now, if the business is doing transactions on a regular basis, so they will earn profit. And sometimes what happens that a company thinks that we have earned a lot of profits. Let's do one thing. Let's make a reserve. Let's keep aside some of the profits for the future mishappenings, for which a company transfers some of the amount, a portion of the profit to its reserves. The reserves which is being made out of the profits is again a liability, is again an internal liability, because that's the amount which has been taken out from the profit. So initially, the profit is basically an internal liability. So as well, the reserves also are the internal liabilities which are owed to the owners itself. Okay, so when we talk about the internal liabilities, so it is basically the initial amount, that is basically the capital invested by the owners, the sole proprietors, partners, or the shareholders, and apart from that, all the amount of profit which a company has earned, or else the amount of reserves which have been transferred from the profit itself. So this was the full information about the internal liability. Now, let's talk about the external liability. External liability, as the name suggests, the amount which is due to be paid to the external persons, to the outsiders. Now the question arises, who are the outsiders? Outsiders are those persons from whom we might have taken the goods on credit, or else we might have taken a loan from the bank. So all the persons or the organization from whom we have taken the goods or we have taken the money are basically our external liabilities. For example, the goods which we take when we buy the goods from a person to whom we have not yet paid the amount are known as creditors. So the creditors are basically the external liabilities. Apart from that, suppose we had to buy some of the goods or we had to buy some of the assets for which we didn't have the money right away. So what did we do? We went to the bank and we asked for the loan. So the amount of money which a bank has provided to us in the form of loan is also an external liability itself. Okay, so when I talk about external liabilities, it is the liability which we owe to the other person, which is not inside the business, but it is outside the business. So there are two types of external liabilities. The first one is the non-current liabilities. The second is the current liabilities. Non-current liabilities are the liabilities which are to be paid after a year. That is, the benefit for the amount which you have taken from the persons or the business organization will be with us for a longer period of time. That is, say more than 1 year or more than one operating cycle. For example, if I have taken a loan of rupees 10 lakhs for say 5 years, so obviously I will pay the amount after 5 years as a whole, or else I might pay the amount in an equal monthly installment. So the amount which has been taken from a bank for more than 1 year is termed as a non-current liability. Okay. Now, apart from that, the loans taken from the different financial institutions is also a part of your non-current liability itself. Now, next, let's come to the current liabilities portion. Current liabilities is the amount which will be paid within a period of 1 year or within the period of one operating cycle. So, when I talk about one operating cycle or within 1 year, obviously the amount which is to be paid will be paid to the creditors from whom we have purchased the goods on credit. Okay, we might have purchased the assets also on credit, but make sure that the amount should be paid off within a year itself. So all these items, all the money which has to be paid to the external persons, those are known as the creditors. So it will be paid within a year. So it is basically your current liability. The next example for the current liabilities is the bank overdraft. Now, what is the meaning of bank overdraft? For example, let's take an example to explain this. Suppose we have 50,000 in our bank account and we have to make a payment to someone for rupees 80,000. So what did we do? We simply paid the check, we made the check, we issued the check to that person. That person will carry this check of 80,000 to the bank and he will go to the bank and ask for 80,000. Now what happens is, when the banker checks the amount in my bank account, he will see that there are only 50,000 available in my bank account. So he will immediately call me and he will ask me whether to dishonor the check or what has to be done for this check, because you don't have the sufficient balance in your bank account. So at that moment, the bank gives a facility which is known as bank overdraft, which simply means you can withdraw the amount more as compared to the amount you have in your bank account. So whenever there is an overdraft, that is, whenever the person, the owner, overdraws the amount from their businesses, from the bank, so it is known as bank overdraft facility. It is a short-term liability, it is a short-term loan which is provided by the bank to the businesses. Okay, so this is also a current liability only. Next, when we talk about the outstanding expenses, for example, I have an employee who is working for me, but what happens is in one of the month, I didn't have the amount to pay him the salary. So what I asked him, if he can get the amount after a month or so. So if he agrees, so what happens? This type of liability is basically for the amount which has to be paid to the employee after a period of time, like say after a month or two. So this is also a current liability itself, because the amount for this will not be paid immediately, but will be paid afterwards. So these type of expenses, which the services we have received, but the amount has not been paid, is known as outstanding expenses. Now, next, apart from that, we also have an example of advance income. Now, what is the meaning of advance income? The income is the amount which we earn by giving the services or by selling the goods. So, whenever we are giving the services, or else we have to give the services, we would have received the commission. But what happened? In order to give the services, we asked from our client an advance amount. So, the money which we receive in advance. So, the money which we receive in advance from the clients, from our customers, that is basically known as advance income, because the work has not yet been done, but we have received the amount in advance. So obviously it is our liability where we will have to pay back this amount if we are not in a position to do that work, or else we will have to do the work because we have received the amount beforehand itself. So these were the examples for your current liabilities and the non-current liabilities. I hope this full explanation regarding the current liabilities and non-current liabilities is very much clear to you. Now, at the end, there is one more liability which is known as the contingent liability. Contingent liability is that liability which is not sure, which is totally not sure. For example, there is a case filed upon us by a customer. We had delivered him a wrong product, or else we had delivered him a defective product. So what happened? He suffered a loss due to that, and he went to the court and had filed a case upon us. Now, what will happen? If the court agrees that yes, the customer is right, then the business will have to pay the amount to the customer. So when the business will have to pay the amount to customers, it will become a liability. But till the time there is no result from the court, so it is basically known as the contingent liability, because we don't know exactly what is the amount which has to be paid to that particular customer. So that's why it is known as contingent liability, which simply means the result of this, the liability will be assured only after the decision of the court. So the amount will be paid after a particular activity only. Is that clear? So this is basically a contingent liability which is not to be shown in the balance sheet, which is not to be shown in the books of the accounts, but has to be written outside the liabilities as a footnote. Footnote simply means the note which appears at the end of the balance sheet, where it is written outside the balance sheet. So this is basically known as the contingent liability. Now, we also have the provisions. Now the question arises, what is the meaning of provisions? Provision is basically a current liability. Provision simply means the amount which we will have to pay in future. There might be a loss. What happens is, when a person is working for me, I know I am liable to pay him the amount. That is the exact amount which will be paid to the employee. Okay, now for example, I have sold some of the goods to my customers, and I know that the customers might ask for a discount. The customers might be possible they won't pay some amount to me. So it is a normal thing in a business where some of the amount is lost due to the negligence of the customer, where the customer says we are not able to pay, something went wrong with us. So these are the things on a normal course. Now, for this only, we have to make the provisions. We have to set aside a profit which will be, if at all there is a loss in the future, will be set off from this provision itself. So that is basically a provision. So it also comes under the current liabilities itself. So this was the full explanation about the types of liabilities and what was the meaning of liability. I hope you enjoyed this video. Thank you so much.